What are the fixed income opportunities or the bond opportunities here in the United States?
Well, the two best performing asset classes that we've seen year to date, right out of the gate, are leveraged finance. Bank loans up 2.2%, and then high yield up about 0.3%. We also think there's some other opportunities where there's been a big sell-off in emerging markets, starting to look at some of the local currency opportunities that we've seen there. Very recently, you've had Argentina trying to defend their currency. They've raised rates. Talk about a Fed raising rates. They raised rates in 3 days, 1,275 basis points. That contagion fell over to Turkey, to Brazil, to Mexico, to Russia.
But I want to underscore local currency opportunities,
yes.
Right? Because the dollar and the strengthening of the dollar is what has really roiled a lot of the emerging markets, particularly the debt. So
exactly.
You're looking specifically at trying to avoid that risk in this trade.
Sure, that's been the exact reason. You have a strong dollar and rates are going up. I think you still have decent fundamentals in the emerging economies. However, when you can look at Turkey two-year notes in local currency at 18%, you can look at Russia and the 10-year at 7.5%. You can look at Mexico at 7.95. Obviously, Mexico has elections coming up in July, NAFTA. In Russia, you have the threat of sanctions and oil, and then in India, an election coming up June 24th.
Dave, when you look at the equity market, it seems as though investors want strong balance sheet. When you look at the debt market, though, you're seeing an outperformance in high yield over investment grade. Obviously, investors on that side are not as concerned about balance sheets. Is that more a function of less supply in the high yield market, or what does an investor extrapolate from that divergence?
Well, Joe, I think you had a big rate move front end loaded. A lot of the performance that we've seen out of investment grade and below investment grade is due to duration. The investment grade market has a duration of about 7 years with a coupon in the right around 4%. The high yield market has a duration of about 4 years with a coupon in the 6s. So a lot of that was due to duration and movement of rates. But if you look at outperformance, I would pick, if I had leveraged finance, I would choose bank loans over high yield. I think bank loans have a much better opportunity set. You have a floating rate asset, you're senior in the capital structure. 50% of all loans also have outstanding debt. It's a very cheap trade to sell the subordinated debt, move up in the capital structure, not give up a lot of yield, and protect yourself from an interest rate hedge and a senior claim on assets.
In terms of emerging markets and the Fed has basically telegraphed that they don't want to be as concerned about what's going on in the emerging markets in determining monetary policy here in the United States.
Correct.
But should we, as investors, be concerned, or is there not a clear mechanism of transmission in terms of contagion to the U.S. financial system?
Right. I would say that over the next from now to September, our 10-year Treasury is probably going to be range bound, probably 275 to 3.25. If Draghi announces that he's going to actually begin to what we believe reduce tapering in September through December and then shut down tapering, I think you could see the 10-year move pretty dramatically here. 10-year Treasury gets to 4%. You can see a slowdown in the housing market. You could see a slowdown in risk assets. You could definitely see impacts in the emerging market. So it's not a direct one.
It's sort of a
right. I'd be concerned if rates start to get up around the 4% range.
Yeah, I'd agree with that. I mean, 4%, you start to get what has been restrictive in the past. Generally, it's been 5%, but I think you got to dial that back. But clear this up. We've had this big debate. I'm on the side that a rising dollar is bad for the emerging markets because of dollar-denominated debt. And I'm told, no, that doesn't exist anymore. That's old school. But yet we've seen that. Right. So what's the reality of it?
The reality is, I think fundamentals are still strong. I think it was much more of a technical move.
Right.
Much more
here to the dollar.
Correct. Which could be short-lived. If we see the rate increases not being aggressive and being pretty moderate, we could see emerging markets come scream back. That's why we're looking at opportunities, especially in local currency right now.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.